This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, just a few outstanding issues now to clear up in the context of group relief that we had focused our attention on in our last session together. We'll complete those and then we'll move on to look at the situation of gains group membership. Now, what we suggested at the end of last time, and we'd mentioned it during the session, was that when we group relieve, we can only group relieve the available current period trading loss against the claimant company's TTP of a corresponding accounting period. Now, you would expect that if you've got 75% ownership of a subsidiary, that you would be having the companies prepare accounts to the same date. But the examiners can do whatever they like. So what happens in this situation here? Where the accounting periods of two group companies are different, then group relief will be restricted to the corresponding, or as we may call it, the coterminous period. So what we've got to do, it's going to be necessary to time apportion both the loss-making period and the profit-making periods to calculate how much loss may be set off against how much profit in each chargeable accounting period. We've got to work out what is the corresponding period. Now, we've got a little example 3 here, which continues with example 2. Now, you might need to just go back and have a little look reminder there of example 2, where we had to sort out who could group relieve with whom, where we had the principal parent company of Z plc making a trading loss for the year ended March 17. It then had share interests in, well, let's take you back and show you there. It had share interests in A Limited and then the object of this question, B Limited. We saw that Z could group relieve with both A and also with B. With A because it had a 100% direct link, and with B because it had an indirect effective holding of 80%. Both satisfied the 75% rules. So, in this particular problem now, we are posing the point that Z could indeed group relieve with B, but what about if B Limited had commenced trading on the 1st of October 16? Therefore, its accounting period was for the 6-month period to 31st of March 17. So Z had a trading loss for the year ended March 17, whereas the claimant, the profit-making company, had accounts of only a 6-month period to 31st of March 17. Well, what we'd now have is that all of that 6-month period to the 31st of March 17 falls within the loss maker's year ended March 17. That period of 6 months all falls in one accounting period. It doesn't span 2 accounting periods there of the loss maker. It's all within, it is 6 months of the year ended March 17. So all we know is that we could now take just 6 months of the loss made by Z, because only 6 months of its year ended 31st of March 17 corresponds with B Limited's 6-month period to the 31st of March 17. So 6/12 of the loss could go against all of the profit made by B Limited in its 6-month period to 31st of March. But only 6 months of the loss corresponds with that 6-month profit period. Okay, now there we have both companies preparing accounts to the same date, the 31st of March 17. The only problem is that B Limited has only just commenced trading, so its accounting period is of only 6 months duration. But what about if we have 2 different accounting dates, non-coterminous accounting dates there? Well, let's have a little look at, and here we go, a little example that I've set up for you here. Right, we're now assuming that we've got 2 companies. Here our first company prepares accounts to December in each year, and for the year ended December 16 has made a trading loss of £400,000. So what I've done is draw a little timeline for the loss maker, and its year ended December 16 has a trading loss of £400,000. Secondly, we have the member of its 75% group with whom it may group relieve. But the profit maker prepares accounts to the 31st of March. Now, there are two year ends, the 31st of March, that correspond in part to the loss maker's year ended December 16. They are the year ended March 16 and the year ended March 17. So, how many months of loss can go against how many months of profit? So, we have there the year ended March 16 goes 3 months into the year ended December 16. So that means that here we have got a 3-month corresponding period. Therefore, 3/12 of that profit would equal £75,000 worth of claimant company's profit, and it would be available to be relieved by 3 months worth, 3/12 of the loss of 400. So that would be £100,000 of loss. So we're going to divide out that loss of 400 there, 3/12, 9/12, between the two accounting periods of profit to which the loss-making period corresponds. The year ended December 16 falls 3 months in the year ended March 16 and 9 months in the year ended March 17 of the profit maker. So 3 months of the loss against 3 months of the profit. £100,000 of loss would have been available to be group relieved, but it can only be group relieved against £75,000 worth of profit. So the maximum group relief there is £75,000. Looking at how much of the loss, 9 months worth of the loss, 9/12 of the loss of 400, 300,000 of the loss is available to set off against not all of the 480, but the corresponding bit, 9 months worth of the 480, and 9/12 of 480 is, I think, oh, that's not a loss, that's a profit, that will be £360,000. So your loss at 300 is the smaller of the two figures. All of that loss of 300 can be group relieved against that profit of 360, it being 9 months worth of the £480,000 profit made within the year ended 31st of March 17. So we're able to work out on the coterminus, the corresponding accounting periods, that 3 months of the loss of the year ended December 16 can go against 3 months of the profit of the year ended 31st of March 16. Then the remaining 9 months worth of the loss of the year ended December 16 goes against 9 months worth of the profit of the year ended March 17. We must time apportion both the loss, 3/12, 9/12, that was £100,000 and £300,000 respectively, 100,000, 300,000, and then time apportion the profit against which it may then be relieved. We had 3/12 of the profit of 300 being 75,000. That was less than 100,000, so the maximum group relief there was 75. We then had 300,000 loss against £360,000 worth of profit. There's more than sufficient profit able to absorb the £300,000 loss, so it's the 300,000 that would be your maximum group relief claim against the profits of the year ended March 17. Now, just to make life even more interesting, if we take away some of these calculations, so do note them down, pause if you need to note down these calculations that we've done, and make certain that you are happy with them. All right, what I'm now going to do, if I just cross that out for one moment. What I'm now going to suggest is that the profit-making company that prepares accounts to 31st of March 17, if I now told you that at this date, let me think, the 1st of July 15, that it commenced trading. So it only commenced trading on the 1st of July 15 there. So what would that mean now about the maximum group relief available in relation to the loss of 400,000 made within the year ended December 16? What now would be the amount of group relief claim that could be made? The point now is that having started here on the 1st of July 15, there will be only a 9-month accounting period through to the 31st of March of 16. So can you work out for me, please, the maximum group relief that would now be available there, please? Well, hopefully you've had a go at that now and established what you believe to be the available group relief. If, by the way, your screen went a little bit fuzzy there, a few technical problems at this end, which hopefully now have all been sorted out. So let's continue with what that exercise required you to do. Again, it's just a matter of matching the corresponding period. And the only thing that has changed is we've still got a 3-month matching period there from the 1st of January 16 to the 31st of March 16. So we've still got 3 months worth of that loss. It was a 12-month loss-making period in which you made 400,000. So we've still got 3/12 of 400,000. That's £100,000 of loss in that period. And it still matches up with 3 months worth of the profit-making period. But that 3 months worth is now out of a 9-month period. Therefore, the denominator is reduced to 9 instead of 12. And of course, 3/9 of 300 is £100,000 worth of profit. This time is available to be group relieved. How much loss do we have available? £100,000 worth of loss. So in fact now, all of the £100,000 of loss could be group relieved against the £300,000 of profit for the 9 months to 31st of March 16, given that the maximum group relief available is that 3/9 of 300, the corresponding period, and that's £100,000 worth of profit to be group relieved if you choose to make that claim. Okay, so in which case, therefore, we should now be able to deal with non-coterminous accounting periods, and in that respect, a rather lengthier exercise, a more challenging one for you to have a go at now. If I could ask you to turn to example 4 and have a go at that. I'll just introduce it to you and then leave you to have a little go at working out the answers. The requirement: compute the maximum group relief claims available to J Limited and Z Limited in respect of Beyoncé's loss. I suppose I said J Limited and Z Limited, I guess I should have said there, but J Limited and Z Limited in respect of Beyoncé's loss of £240,000. Okay, what's going on? Beyoncé, the loss maker, prepares its accounts to 31st of March in each year, and it's got 2 wholly owned subsidiaries, J and Z. J Limited and Z Limited there. J Limited has been owned for several years, but prepares its accounts to the 30th of June. So, we have got non-coterminous accounting periods. The loss maker, Beyoncé, apparently for the loss-making period, we'll see what it is in a moment, has a loss of £240,000, and whereas Beyoncé prepares accounts to 31st of March, our profit maker, J Limited, although owned for several years, prepares accounts to the 30th of June. non-coterminous accounting period ends. The issue for Z Limited there is that it started trading only on the 1st of January 17. It made a trading profit of 50,000. So it therefore has only been trading for 3 months within what was Beyonce's year ended the 31st of March 17. It made the trading profit for its 3 months to March 17. Beyonce made a trading loss of 240, yet we know that, and that's in its year ended 31st of March 17. J Limited has a taxable total profit of 160,000 for the year ended 30th of June 16 and £280,000 for the year ended 30th of June 17. Now that's a lot of information to digest there, so you've got to organise it. What we've got to work out is how much loss is available to go against how much profit. So you know what Beyonce has in terms of its loss, 240,000 for the year ended March 17. Then take each company in turn. J Limited has been owned for several years, but prepares accounts to the 30th of June. So for Beyonce, you have an accounting year ended 31st of March of 17, in which it made a loss of £240,000. We then have J Limited that has prepared accounts to the year ended 30th of June, and for its years ended 30th of June 16, it got a profit of £160,000, and for its accounting year end 30th of June 17, it got a profit of £280,000 there. So what we've got to see is how many months worth of the loss-making period correspond with how many months worth of each of the 2 profit-making periods. So that's down to you, therefore, to now do those time apportionments. What you'll then have with your new startup Z Limited there, Z had 3 months to the 31st of March 17, in which it made a profit of £50,000. Now, all of that 3 months to March 17 fits within the year ended March 17 for Beyonce. So all of that 50,000 is available to be group relieved. It all corresponds with the year ended March 17. The question is, how many months worth of that loss does it correspond with? And that might be a bit of a clue. All right, over to you now to sort that out. Part of the problem you have here in dealing with these exam questions is actually analysing and applying then, once you've analysed the information, applying your technical rules to the specific scenario in front of you. Now that hopefully we've got that resolved, it's down to you to do the calculations. So could you work that for me, please, and then look through, review through carefully the answer to that at the back of the notes. So let's see how we've fared, therefore, with this particular example. Again, it was all about piecing the coterminous periods together. Both Beyonce and Jay there have been preparing accounts to the same date for a regular period of years, and all we had to do, therefore, was to work out the coterminous parts. So what we saw was that the loss-making period there of 240 for the year ended March 17, that would correspond with 3 months worth of the profits of the year ended June 16 and 9 months worth of the profits of the year to June 17. That therefore would give us respectively £40,000 and £210,000. What can that be matched with? Well, the respective 3 months and 9 months worth of the loss of 240. So 3 months worth of the loss of 240, that was a loss, better bracket that so we're sure, that would be 60,000, 9 months would be 180,000 there. So what have we got? In terms of the year ended March 17 going against the year ended June 16, 3 months worth of the loss would be 60,000, but the limiting factor, it could only go against 3 months worth of the profit of 160, and that is 40,000. So the maximum group relief there would be £40,000. For the remaining 9 months of the loss-making period, we have got £180,000 worth of loss to go against £210,000 worth of profit. So the maximum group relief there, £180,000. In addition to those loss reliefs being available to those maximum figures, we also had our new subsidiary Z Limited there that made that £50,000 profit in its 3 months to March 17. Well, we've got therefore a coterminous period of 3 months. We already know that 3 months worth of 240 equals £60,000. So if you wished, as there would be available, depending on what other claims you make with J there, but £60,000 of loss would be available to go against the £50,000 worth of profit. So the maximum group relief, you could take out all of that £50,000 worth of profit. Now, all of that is identified in the model answer back, which hopefully by now you have looked through, and therefore with that review also you will be familiar with and hopefully able to deal with a similar exercise should you be presented one in the examination room. Last little point, practical one, payment for group relief. The claimant company who's benefiting from the surrendering company's loss may make payments to the surrendering company for the benefit of the group relief that it has received. Any payment up to the amount of the loss surrendered is ignored for corporation tax purposes. So what that is telling you is that within the group, you are taking the loss away from the loss maker and allowing the profit makers to benefit now from the use of the loss maker's loss. It would be perfectly reasonable, therefore, so as not to disadvantage the loss maker anymore, for those who've got the use of the loss to take back or to pay back the benefit of the tax saving that they have received, pay that back to the surrendering company. Now, there's no requirement to do that. If the group wishes to do it, they may do it, and those payments and receipts are outside the scope of the corporate tax system. They're ignored for CT purposes. So the payment by the claimant company back to the surrendering company, the payment is not a deduction for the payer, it's not income to the recipient. Again, you can make those payments if you wish, but you don't have to. Again, down to the group to decide, but it would seem like a fair and reasonable thing to do. Again, not a term to be used now, I'd hasten to add, in the examination room, but I always think about this as a sort of reverse Robin Hood situation if we don't do something about it. Now, if you know the legend of Robin Hood, you will be familiar with the fact that he was famous for taking from the rich and giving to the poor. Took from the rich and gave to the poor. Now look at our group situation. The loss maker is the poor one. The profit maker is the rich one. So group relief, what is he doing? It's taking from the poor and giving to the rich. Just think, if that loss was not taken away from the loss maker at this point and group relieved within the group this period, even if the loss maker couldn't use the loss now, it could use it in the future, it could carry it forward, and therefore would reduce its future profits, therefore reducing its future tax. That cash benefit has been taken away from it. It now doesn't have that loss, and it will pay bigger tax in the future when it becomes profitable again. So it would seem like a perfectly fair and reasonable thing to do there to make the payments from the claimant to the surrendering company. Again, remember, if you want to do it, you can do it, and if you do it, then those payments and receipts are outside the scope of the taxation system. But if you don't want to do it, there is no requirement so to do. Down to you to decide. Okay, Moving on, therefore, to the last area, and last substantive area, certainly, and that's to deal with chargeable gains groups. Now, the first thing that we've got to do is to determine who is in a gains group, and then, so what? What happens within a gains group? Another one of those combinations that we get in groups of there are rules that have to be applied to deal with a certain type of transaction, a certain issue, and then there will be claims elections that are available to the group members that would allow them to improve what would otherwise have been their tax position. But firstly, who is in the 75% group? Now, of course, it means that if we've got direct shareholdings, then of course a group consists of a parent company and its 75% subsidiaries. And also the 75% subsidiaries of their subsidiaries. Each direct link has to be 75%. So when you go from parent to direct subsidiary, link must be minimum 75. When you go from subsidiary to sub-subsidiary, direct link must be 75%. But unlike with group relief, the effective interest from the principal parent company down to the sub-subsidiary, the indirect sub, needs only be 51%, i.e. over 50%. So a different relationship, inasmuch as although the direct relationships must still be 75%, the indirect doesn't have to be. It only has to be more than 50%, unlike the situation so far as group relief was concerned. If we have a little look at the example that we saw before when dealing with group relief, we had our principal parent company Villa with its direct subs A and V and its indirect subs F and C. And what we saw was that for group relief purposes there were two groups. We had Villa, A, V and F all in the same effective 75% group. 90% of 90%, you'll remember, was 81%. So any one of those four companies could group relieve with any other. F, A and Villa could not group relieve with company C. V, however, could group relieve with company C, and C could group relieve with V. The reason why the other Villa group members, Villa, A and F, could not group relieve with C was this problem. 80% of 80% was 64%. You didn't have the effective 75 working back to the principal parent company, Villa. But what is the situation now for gains group membership? And for gains group membership, all 5 companies, including company C, are in the same gains group. How come? The direct link between Villa and V, 80%. The direct link between V and C, 80%. Both satisfying the 75% percentage requirement. The effective, 64, that is more than 50%. So on that basis, therefore, yes, company C is in the same gains group as the other Villa group members. So the rules will be as applicable to it as to any of the other Villa group members. Watch out in terms of an exam question. I'm thinking particularly now about an objective testing question, a multiple choice question. Inasmuch as often what students do is, rather than remembering the full rule, what they remember is, oh yeah, with group relief on a sub-subsidiary, you needed effective 75%, whereas on a gains group, you need only have effective 51. And that's all they remember. And then they come to this example, and if we now made this example, instead of V owning 80% of company C, if I now made that 70%, and we ask the question whether or not C is still in a gains group within the Villa group of companies. Now, if you went on effective, you'd go 80% of 70% is 56. 56 is more than 50, therefore you have an effective 51%. And sadly, that's where students make the mistake by thinking, well, that's fine then, C is in the same gains group. No, it isn't, because the initial rule has to be remembered first of all. And that was that each direct link needed to be the required 75%. And that link, that direct link from V to C, is only 70%. It had to be a minimum 75% for gains group membership to apply to company C. So don't make that mistake. Be careful, watch out for that in an examination question there. Okay, going back to our notes, as soon as we've determined which companies are in the same gains group, then of course, so what? There are three main points here. The first of which is a rule that has to be followed. There is no choice, there's no election, there's no claim. It's a rule. Do this and you must do it this way. Whereas in the second lot of two, parts B and C, those are elections that are available to be made if the group company chooses so to do it. So the first one, the rule. Group companies will transfer assets between them. These are chargeable assets subject to the capital gains rules, without incurring a chargeable gain or an allowable loss. The expression that we refer to here, this will be known as a no gain, no loss transfer. Other texts may refer to a nil gain, nil loss transfer. We're talking about the same thing. A no gain, no loss transfer, therefore, will be deemed to have taken place between the two companies. So the transferor company will not have a gain or a loss. So we have to work out what, therefore, would that deemed consideration be. So the transfer, no gain, no loss transfer, will be deemed to take place at a value equal to the cost of the asset to the transferor plus the available indexation allowance at that date to the transferor. So no gain, no loss equals cost plus indexation allowance at the date of the transfer to the transferor. So on that basis, therefore, if you had a situation where between two gains group members you had a transfer, so for example, let's go back to our scenario here, we had company F that had the cost of a building at, say, £400,000. And that is to be transferred across to company C. Let's now go back to the original 80% holding and the original effective 64%. Remember, on that structure, C is in the same gains group. And that transfer was, for accounting purposes, what went through the books at an open market value of £700,000. Now, although for accounting purposes, the transfer probably will be at market value, for tax purposes, it's no gain, no loss. And no gain, no loss means that it goes across from F to C at a consideration, a deemed consideration, that gives neither a gain nor a loss to company F. And that is its cost of £400,000 plus its available indexation. So if I told you that at the time of that transfer, the indexation factor available was 0.25 on a cost of 400, that would give you indexation allowance of, I think, £100,000. So the no gain, no loss transfer would be cost 400 plus indexation 100. It would be £500,000. So at the time of transfer, company F does not make a gain of 200,000. That would have been the case based on a third-party sale at its market value of 700. It makes neither a gain nor a loss. And going into C, therefore, at a base cost equal to the value of the no gain, no loss transfer, £500,000. What that means is that if in the future Company C were then to sell that asset against any sales proceeds made by the sale or on the sale by Company C, you would therefore deem that C to have acquired at a cost of £500,000, and you'd index from the date of the no gain, no loss transfer through to that future date of disposal and apply that indexation factor to its deemed cost of £500,000. It is as if the cost was indeed £500,000, and that is what you use for taxation purposes. No gain, no loss transfers are automatic. It's not a choice. That is what happens when you transfer a chargeable asset within the gains group. That, as we said, was a rule. But there are then two elections, one of which we mentioned in our original introduction to groups. That one is for members of a 75% group can be treated as one for purposes of rollover, i.e. group rollover relief is available. Group rollover, if I just abbreviate that, group rollover relief is available. It's ever so simple. One gains group member sells a qualifying business asset, almost certainly a property. Another company buys a qualifying asset, again almost certainly a property, within the rollover relief qualifying time period. Remember, between a year before to 3 years after the disposal date. Then rollover is possible. Now, the normal rollover rules apply. If we have reinvested all of the proceeds the buying company has bought for at least the sales proceeds figure of the vendor, then full rollover is available. If, of course, we fail to reinvest all of the proceeds, then it is only partial rollover. So it's exactly the same rules as before. It just doesn't have to be the same company that does both the selling and the buying. That's group rollover relief. We've then got this new one, an election here. The company can make election such that any part of a capital gain or loss incurred by one gains group member, one company in the gains group, may be treated as arising in any other company. Again, to give it a name, it's known as the matching election. Because what it allows us to do is to match gains with losses. So within your group, you can allow during the accounting period for individual companies to sell off their own chargeable assets and make whatever gains or losses that then arise. We don't have to worry about planning for which companies should have gains or losses, because after the end of the accounting period, we can come along and make this matching election that will allow us to deem that any part of a gain or loss made by one company has in fact been made by any other gains group member. A most generous claim indeed. What that initially allows you to do is to avoid the situation of in one company having to carry forward what would be an unused capital loss, while in the same accounting period in a different gains group member having a chargeable gain that is then charged to corporation tax this period. We can now match. And the beauty of it is that with this matching election, you can go in either direction, i.e., you can move the gain to the loss or the loss to the gain. That's why we said earlier that there's no such thing as group relief of capital losses. It's actually better than that, because it's not just about moving a loss out of the loss-making company and into a company with a chargeable gain. We can take any part of a gain made in one company and deem it to have been made by the company with the loss. We can take the gain to the loss or the loss to the gain. The only restriction here, any part of a current period gain or loss is what may be moved. We cannot move a brought forward capital loss, but we'll talk more about that in a moment. Advantages of the gains group membership, as we've just said, the group's capital losses can be better utilised. We ensure that we don't end up with an unused capital loss in one company while paying tax on gains in another. Rollover relief is available on a group-wide basis. Doesn't have to be the same company doing both the selling and the buying. Gains may be moved to a company with insufficient profits to cover its qualifying charitable donations there. So again, something now that can be done here to get a better use of deductions that apply from profits. We know that if we have insufficient profits to absorb qualifying charitable donations, that we might end up with a situation of them being lost. We might end up with that situation. That can now be avoided by moving gains to boost profits of a company and therefore to ensure that you've got sufficient profits so as not to waste any of the donations. Capital losses. An asset does not have to be moved between group companies in order to match losses against gains. We can let each and every company make its own gains or losses and then move those gains or losses around at will, not just in total, but in part. Companies in a capital gains group can make the election to deem any part of a current period gain or current period loss made by one group member to have been made by any other gains group member. Plenty of time to make it within 2 years of the end of the accounting period in which the asset is disposed of outside the group. The advantages means that we can do this retrospectively. We can allow companies individually to sell their own assets and not worry about matching. We can do it later. By not having to actually transfer assets within the group means a saving in legal and administrative costs, and the election could be made in respect of any part of a capital gain or loss. Again, it doesn't have to be the entirety of it. Okay, we've got a little example here, example 5, where we need to discuss the elections available to the group companies and how they may best be used. Now, to understand that, of course, we also need to understand why you would be moving gains and losses around. Well, one, very obvious, by the name, matching election. You want to match gains with losses. So, if therefore, like in this example, during the year ended March 17, Large Limited, bit of a clue there, disposed of an asset that resulted in a capital loss of 35,000, Smaller Limited, the 100% subsidiary of Large, disposed of an asset that resulted in a capital gain of £100,000. What we now know is that we can match the gains with that loss. We could move the loss to the gain, or we could move £35,000 of the gain or more to the company with the capital loss. We can go in either direction. Now, the initial impact is the same. You match the gain with that loss. It means that somewhere in that group, either in large or in smaller, you are going to end up with a net gain of 35 from 100. You've got a net gain of £65,000 there. So then the question is, where would you want that net gain? And that's where the next bit comes in. Large has a TTP of 1 million and Smaller Limited has a TTP of 800,000. What we have is Large Limited has the loss of 35,000. Smaller, its 100% sub, it has the gain of £100,000. So at this point in time, Smaller Limited has a TTP, including the chargeable gain, of £800,000. So included in that 800,000 is £100,000 worth of gain. Now there are two companies in the group. We're told it's going to anticipates larger profits in the next accounting period. Large Limited holds no other shareholdings. Therefore, there are two related 51% group companies. That means that the profit limit of 1.5 million will be divided by 2. So each will have a profit limit of £750,000. Now what that means is that if, as at the moment, each has a profit in excess of £750,000, or at least at a figure of 750,000 plus, then both would be required to make quarterly instalment payments next period, if not indeed in this period, presuming that for next period we were estimating that the company was going to be large. So what you've got to do is to sort out the fact that you can move any part of that gain out of the company with the gain. You could move any part of that loss out of the company with the loss. Whichever way you go, you end up with a net gain of £65,000. Well, would you want all of that net gain in one or other of the companies? That is the question. Now, I've taken you far enough on that. You think, how and in which company might you be able to avoid the prospect of quarterly instalment payments being made? You can only do it in one company. Which company, and how would you achieve that? Have a little think, have a little write down there of that answer, and then check it out with the answer in the back. And when you come back and rejoin us, pause it now, we will discuss said answer. Okay, well, I hope that you've now performed that particular exercise, example 5, and you've read through the answer here. If not, you better switch this off again and go back and redo it, and then check this out before listening to this final bit of review. Now, again, we had made the point that both companies were in the same gains group. That was very obvious. One had a current period gain, one had a current period loss. You could therefore move the loss to the gain, or the gain to the loss, or any part of the gain to the loss. But it would mean that if you did that, and you move, say, the loss to the gain, or 35,000 of the gain to the loss, somewhere in the group, you're going to end up with a £65,000 net gain. Now, if we simply moved the loss to the gain, Smaller Limited's gain of 100 would be reduced by 35,000, leaving it with 65, thus reducing its TTP down from the current 800,000 to £765,000. That's a problem, because it would mean that it would remain a large company and therefore subject to quarterly instalment payments next period, if indeed not just this period as well, depending on were we large in the previous period. Again, if you've forgotten those rules of where the quarterly instalment payments arise, go back to the earlier chapter where we dealt with that. Okay, so here therefore we're going to have to reduce the profits of Smaller from 800,000 down to a maximum £750,000. Now, you can go lower if you like, but if we bring it down to 750, it will not exceed the profit limit, and therefore quarterly instalment payments would not now be required for the current period, and therefore neither would they be required for the next period, irrespective of whether we were estimating that period to be large or otherwise. So, what we're going to do, therefore, take 50,000 of our £100,000 gain and deem it to have been made by large. That will offset the 35,000 loss and leave it with a net gain of £15,000. Now, you could take more of the gain out of Smaller and give it to large there. That wouldn't make any difference. The whole point was that you didn't want Smaller to have profits in excess of £750,000. Keep it, therefore, at not above that revised profit limit for the two related 51% group companies. So doing there with your gains, what you'd be doing with group relief of losses, whereby what are our objectives? We're trying to get relief at the earliest available opportunity. We are trying to ensure that we are able to get a cash flow advantage that way, and that cash flow advantage would also be achieved in terms of avoiding quarterly instalment payments. You really don't want to be starting to pay your tax 7 months into the current accounting period. you want to be paying all of that tax 9 months and 1 day after the end of the period. So avoid quarterly instalment payments if you can. The other issue, as we know, we'd like to avoid wasting qualifying charitable donations. Therefore, by being able to move gains around, you could put gains into companies that might otherwise have unused qualifying charitable donations, assuming that is that those excess qualifying charitable donations would not otherwise have been available to be group relieved. If they would, then you can still get the benefit of it elsewhere. Otherwise, move the gain to absorb that donation. So all our normal objectives as regards getting the best use out of losses, again go back to the earlier chapter on corporate tax losses to remind what those objectives are, and then rework through this chapter on groups. Also, having reviewed through, you'll see at the end of the chapter a further note saying you can now look at the technical article written by the F6 examining team entitled Groups. And again, don't just read it, but as with all of those articles, work through those articles to ensure that the examples used are examples that you are able to answer with your knowledge. Simply reading what is in front of you is insufficient. You must work through those articles. That will take time, but it'll be time very well worthwhile being spent. If the examiner writes to you, I suggest that you read and understand what he has written. They're not doing it just for the sake of it. They're saying, if I've bothered to write about it, I think it's important, and these areas will be coming up in forthcoming examination questions. Okay, that therefore completes our study of corporate tax now that we've dealt with the group's issues. There's bits of admin for you to read through in the admin chapters there for both personal tax, income tax and CGT as we saw it, and also now corporate tax. But it leaves two outstanding taxes still relevant to us that need to be covered, they being value-added tax and inheritance tax in the two main chapters that follow this. There's also now for Finance Act 16, given the new issues that have come in and the new style of exam, there's a planning chapter 26 as well for you to review through. It brings together things that we have done in the past, but in a planning context. Okay, I look forward therefore to next talking to you about VAT.